Joining us right now on whether it's time to buy the banks is David Chiaverini. He is the managing director at Wedbush. He actually upgraded Western Alliance from neutral to outperform and added it to Wedbush's best ideas list. And David, it sounds like you think at least for some of these banks, the all clear is kind of signaling at this point.
That's right. Western Alliance was one of the more vulnerable banks right after SVB went down. 14% of their deposits were venture-backed deposits, so that made it a natural kind of target after SVB went down. They've cured that and brought it down to 8%. So that's improved. And when I say cured, it's because those deposits did outflow to get it down to 8%. The other issue was that at December 31st, they had 45% of their deposits were insured. They've improved that to now 73% of deposits. And then right after SVB went down, there was a lot of concern around fair value marks, not only on securities, but on loan values. And their tangible book value on a fair value basis was $3. That's down, compared to $40 on a GAAP basis. They've improved that at March 31st to $17. And then lastly, deposits. Deposits did decline, down $6 billion sequentially, or 11%. But since quarter end, deposits are up $2 billion. So we've seen a nice rebound. And with the stock trading at 4 times earnings before we upgraded it, we think it was worth the risk to upgrade.
Yeah, when you say improved some of those ratios, it's because a lot of those deposits went away to the tune of $6 billion. The $2 billion that came in, where did they come from?
Yeah, so they said some of the deposits have come back from commercial customers where they've had conversations and really they want to partner with the borrowers that they're lending to keep those and make those deposits that much more sticky.
Does that mean that they're going to have to pay much higher interest to keep some of those deposits or offer other sort of loans at improved rates, lower rates, in order to keep that business in?
Absolutely. Yeah, it's happening to them. It's happening across the industry. Deposit costs and funding costs are going to be going up across the board. Right now, what was getting priced into the stock was the potential for it to, possibly go away. But that risk is essentially off the table now. And the other thing that they're doing is they're converting some of their deposits into and using a service for reciprocal deposits in which they're able to spread out deposits with other banks. Now, we do think that that's going to lead to higher deposit costs, but nonetheless, those deposits do become insured and should be more stable than uninsured deposits.
Okay, let's just talk about valuation, because you're right. That stock went from $60 or something down to $44, $45. That's a big haircut, and it was pricing in a lot, as you said, the idea that that bank was going to be under much more pressure. From a profitability perspective, with costs going up, what's a fair price for the stock at this point?
Yeah, so we increased our target to $50, and that's based on 6 times our 2023 earnings estimate. And the group is trading at 6.5, 7 times. So with it currently trading at 5 times, we think that we could see some appreciation in the stock. And yet it had sold off significantly. It, in fact, got down to, 7 and change on that Monday after SVB went down. But it's had a really nice rally since then.
You've added some other banks, too, Regions Financial, M&T Bank, New York Community Bank, to your best ideas list. Is it the same thesis there?
It's a little bit different for the others in that they, of course, all banks have gotten beaten up. But the theme here is the insured deposit level for these companies are above average, and we expect deposit levels to stay a bit more stable. The other issue is we think net interest margins are going to be locked in even if we do get a recession and interest rates do come down significantly. Both Regions and M&T Bank have used swaps to keep their net interest margin elevated. So we think that they're going to perform a bit better than other banks in this environment.
Commercial real estate an issue at any of these banks?
Yes, commercial real estate is going to be an issue kind of across the board. M&T Bank does have an above average level of commercial real estate at 34% of total loans. But we think that their loan to value ratios being sub 60% gives them a lot of cushion. Now, could we see non-performing assets and non-performing loans go up? Yes, we will see that. And we'll probably see, and it's not a good look to see that, but the loss content ought to be much lower than what we see on the surface in terms of the non-performing loans going up. So we're not expecting net charge-offs to go up significantly, but they will come up off of unsustainably low levels.
David Chiaverini at Wedbush. David, thank you.
Thank you.